Thank you. Good afternoon. Thank you all for coming. I'm David Burton. I'm a partner in our New York office and a member of the Tax Transactions and Consulting practice. I'm also leader of Mayor Brown's Renewable Energy Group in New York. I advise clients on a wide range of U.S. tax matters, particular emphasis on project finance and energy transactions. Joining me today as a co-presenter is Junteris from Alfa Business Advisors. Junteris is a director at Alfa Business Advisors. He focuses on providing financial and commercial advice in relation to development of financing, purchase and sale of power generation assets such as solar, wind, gas, hydro, geothermal, and coal. During the past 15 years, he's been involved in numerous project financings and portfolio transactions in North America, Europe, Asia, Latin America, and Africa. As we go along, if you'd like to ask questions during the presentation, please use the Q&A panel if you're joining by webinar on the right side of your screen, or raise your hand if you're here in person. We'll make every effort to answer your questions. We'll try to leave some time at the end for questions. Also, for the live audience, we have cards available on the table. If you'd like to write your questions on the card, and if we don't get to it, then we'll try to answer them afterwards. So any questions not answered during the presentation we'll post answers to on my blog, Tax Equity Times, so that's www.taxequitytimes.com. We're also offering COE credits. We will be providing an Alfa numeric code at some point during the presentation. In order to receive the COE credits, participants must record this code on the virtual sign-in sheet that was emailed to you with your login instructions, or for everyone in the room, you should sign in and then you should have signed in when you checked in, and you should have a sheet in front of you for that code. So with that, we'll get started. So we're going to start by talking about the tax credit extension that was passed in December and the rules as to which projects qualify for what level of tax credits. So we're starting with wind. Wind projects qualify for the Section 45 production tax credit that will ramp down based on a schedule of when the project starts. So if you started in 2015, 2016, you get 100%. If you start after 2016, it ramps down. So you see you get 80%, 60, 40. If you start in 2020, it expires completely. So we have for wind to start construction through 2019. Alternatively, instead of the PTC, a wind project could claim a 30% investment tax credit. So you have a choice of the PTC, which is a 10-year stream over a stream of credits over 10 years, or a 30% investment tax credit you get all up front. The ITC also ramps down, so it ramps down by the same percentage that the PTC would. So if you start construction in 2019, you'd qualify for a 12% ITC, and that's 30% times 40%. So that's the other alternative is the ITC. Solar has a longer runway. So you see you can get solar for starting construction through 2019 at a full 30% ITC, and then it ramps down in 2020 and 2021. And then solar also has a permanent ITC of 10%. So if you start construction in 2022 or later, you get a 10% ITC, and that's permanent. That doesn't require any more congressional action. So there's a permanent 10% ITC. So solar has that. It can count on, and that should be available, but for tax reform changing something. To qualify for more than a 10% ITC, you look to when the project not only has to meet the start construction rules, but also has to be placed in service by the end of 2023. So even if you start construction in 2016, you're not placed in service by the end of 2023, you're not going to get more than a 10% ITC. So solar has this kind of drop-dead placed in service deadline. For whatever reason, wind does not. So for wind, if you start construction in 2016 and you're not done until 2024, you can still qualify for a PTC. But for solar, to get more than 10%, you have to be done by 2023 and in service. Wind does effectively have what I call a soft deadline based on IRS guidance that we'll talk about a few slides later. So there is a kind of the IRS has sort of created its own deadline for completion that tax equity investors are very focused on, but it's not a statutory hard deadline like like for solar. Other renewables, these are now being referred to as the orphaned renewables. They were inadvertently left out of the extension. So here we're talking about geothermal, biomass, landfill gas, incremental hydroelectric, and ocean energy projects. I don't think there's been an ocean energy project yet that's qualified for tax credits, but hopefully we see one soon. So just due to the rush with the extension in December and the other things Congress was focused on, they inadvertently left those out. They've been trying to get them a comparable extension. There was a proposal to include them in a funding bill for the Federal Aviation Administration, but that didn't pass, but it still has momentum. There's a number of supporters who are pushing for it. So hopefully we see these passed. And also for these other renewables, you get the choice of the PTC or a 30% ITC. Another benefit that was extended was bonus depreciation. So this is an additional 50% of depreciation in the first year. So you place the asset in service, you get the regular maker schedule, plus you get an additional 50%. So this was extended. This is not specific to renewables. You get this on cars, computers, anything with a class life of 20 years or less. It does have to be new equipment, so you can't buy a used delivery truck for your business and get bonus depreciation. But if you buy a new, 2016 delivery truck, you would get bonus depreciation. So it's not renewable specific. It too ramps down. It too ramps down over time, but based on a place in service, not start of construction. So it's a different standard than the tax credits. It looks to when the asset's placed in service. And for certain long-lived property, there's you get an extra year. So for instance, transmission lines qualify for an extra year. So you get an extra year. So transmission line, if you're in service in 2020, you get 40%, but for a wind turbine, if you're in service in 2020, you won't, I'm sorry, for a transmission line, if you're in service in 2020, you get 50%, but for a wind turbine, if it's in service in 2020, again, I messed that up, sorry. For a transmission line, you would get 40% bonus if you're in service in 2020, but for a wind turbine, it would just be 30%. So for long-lived things and really in energy, it's really just transmission lines. You get an extra year. Transmission lines, though, don't qualify for tax credits. So the IRS has given us guidance on earlier this year as to what it means to start construction. So this was much anticipated by the wind industry. The solar industry is still waiting. So the solar industry is still waiting. They've said that the government said that it'll be fall or winter before the solar guidance is out, so which is actually sooner than many lawyers were thinking it would be. So it's actually kind of good news that they're saying fall or winter, but they're still leaving the solar industry waiting for a while. For wind, the IRS guidance was relatively flexible or accommodating in that it gave you, from when you started construction, it gave you 4 years to be complete and placed in service. So if you started construction June 1st, 2016, you would have until December 31, 2020 to be complete. So you get 4 years plus December 31st. So you have 4 years and then December 31st to be complete and in service. If you miss the 4 years, then you have to meet the standard of either continuous work or or continuous efforts, depending on whether or not you met the 5% safe harbor I'll talk about. So in order to avoid having to prove that you did something continuously during the whole period that from the day you started construction to when it was complete, many developers and tax equity investors want to see projects in service within this 4-year period. So in service by the December 31st of the 4th year of when construction started. We don't know if solar is going to get a similar 4-year period, or if the IRS and Treasury will say, well, solar can be built more expediently than wind, so therefore they want to shorten it. A 4-year construction period for residential solar does sound a little odd, but we're hoping they do, although at the REF Wall Street conference, a lawyer from Treasury would not commit to that. So she was pressed by questions, and she would not commit to solar having the same 4-year period. I think it's kind of trying to walk a fine line in that they don't want to be accused of being, more favorable towards wind than to solar, but 4 years to complete a residential or a small commercial solar project, you kind of do scratch your head a little bit. So they're trying to kind of balance those two considerations. Let's see. One thing we're facing under this guidance is that the IRS has the ability to say that you started construction before 2016 if you did some work. So developers and investors are starting to worry, well, will the IRS come in and say that, that one shovel of dirt I turned over in 2014 means that I started construction in 2014, so therefore I have only until December 31, 2018 to be finished. So that is something of a concern. The industry was a little bit surprised. The IRS didn't say that the 4 years ran from the later of, December 31st, 2016, and when you started construction. The industry is a little bit surprised, but the IRS is saying they're going to go back. They can, in theory, go back and look. The IRS has not, officially said it's going to do that, but as they wrote the guidance, it does permit them to do that. So that's something that people in this space are struggling with, and those are facts you need to look at very carefully if you did own the land for a while and maybe did some grading or something in years past. For wind, the optimal years to start construction is this year, so I think we're going to see a flurry of activity between now and year end with projects starting construction. That'll mostly involve developers and lawyers, but we will see a flurry of activity. For solar, the optimal year to start construction is 2019. So I think solar is relatively active segment at the moment. So I think we'll see I think we'll continue to see good growth in solar, but these rules aren't going to really compel people to start construction this year, and that'll be more of a 2019 thing. In terms of the starting construction guidance, as I referred to, there are two ways to start construction. The first is physical work of a significant nature, and then the second is the 5% safe harbor, incurring 5% of the cost of the project. And that 5% is 5% of the ultimate cost of the project. So it's not kind of the developer's cost. It's how much is the basis going to be for when the project's placed in service, including any step up that a tax equity investor may claim. So you have to be careful when you're calculating the 5% that you're thinking down the road and kind of the ultimate owner of the project, what its basis is going to be, and not just add up your out-of-pocket costs. If you want to go with the 5% route, you have to take delivery either in the same year you make the payment, or you have 3.5 months after you make the payment to take delivery. So if you make the payment on the very last day of the year, December 31st, you'd have until April 15th to take delivery of the equipment. If you want to take advantage of that 3.5-month rule, you cannot use vendor financing. So if you want your OEM to finance your purchase, and sometimes that's a desirable thing to do. You don't also get that plus the 3.5-month rule. So you kind of have to pick, if you're going from safe harbor, do you want OEM financing, or do you want 3.5 months after payment to get your equipment delivered? Both the significant physical work and the 5% safe harbor follow the Treasury cash grant guidance in general, high level, but there is some difference. We received, in a prior iteration of the tax guidance, clarification that there's no minimum level of work required to meet the significant physical work standard. There used to be concern that, well, maybe you had to, dig 20% of your turbine foundations based on an example in prior guidance. The IRS clarified that there's no minimum amount, there's no 20% standard, they just want you to do the right kind of work. And then the question is, well, what's the right kind of work? Some examples are operational road construction, so it has to be roads that will be used for O&M. Can't be roads that can be used for something that's not O&M. The example the government used to give, which is a little bit, far-fetched, is that if the road is for, like, tourists to see the project, that starting construction on that road doesn't count. But if the road is to bring in equipment for O&M purposes, that does count. As I referred to, digging turbine foundations counts. Manufacturing a customized step-up transformer or any other equipment that's not held in inventory. But it has to be equipment not held in inventory. Ordering stuff that's held in inventory does not count for significant physical work. You can buy inventory and have it count for the 5% test, but not for the significant physical work. If you're going to go with the significant physical work, it's very important that all the work be performed pursuant to a binding written contract. That's a term of art. And it makes sense to have your tax advisor review those contracts, because there's foot faults that can catch you. You don't want to go through all this effort and then find out that you had some foot fault that gets in the way of your significant physical work actually counting. Any questions from the audience about starting construction at this stage? You can take questions at the end, and you can also write them on the note cards, and we'll consider them afterwards as well. Okay, a question?
Yeah, why do you think the solar is going to peak in 2019?
So the question is, why do I think solar is going to peak in 2019? And the answer is, that's the last year to start construction and get the full 30% ITC. So I think in 2019, you're going to see a flurry of developers starting construction to meet these rules to qualify for the full 30% ITC. Because if they start construction in 2020, the ITC ramps down for them. They could start construction in 2018 or before 2019, but then they're not. Then they may not get the advantages of further improvements in technology and declines in prices, that may happen in 2019. So I think 2019 will be the peak year for solar starting construction, unless we see another change in law. If we see another change in law, another tax credit extension, it could be pushed out again. But if the law stays static, I think it'll be 2019. Okay. So thank you for that question. We'll move on to the tax equity markets overview. I like this quote on this page from Solar City. Back in 2007, 2008, when interest rates were around 4%, a tax equity fund could yield a return of 5 to 7%. Now, with interest rates around 1%, tax equity fund can produce 8 to 10% returns, because demand has exceeded supply as the solar market grows. So, what this is really demonstrating is that the tax equity returns are not really about interest rates. They're not moving with LIBOR or treasuries. They're really about that there is a much greater demand for tax equity than there is supply, and it's basically a scarce commodity. So the tax equity investors are a bit in the driver's seat, and they can pretty much politely say to the developers, well, if you don't like it, if you don't like my pricing, keep the tax credits yourselves. And then most developers, that's not a practical solution for them. So wind, in wind, what I'm seeing is an after-tax IRR of 7 to 9.5% unlevered for partnership deals. There's maybe 15 to 20 investors in the wind market, Each is very particular, so each deal only has a handful of candidates. Different investors like different types of equipment. They like different areas of the country. They like different financial structures. So any particular transaction is only going to be within the strike zone of a subgroup of that 15 to 20 investors. The PTC is available only in the partnership and direct ownership structure, so you can do a partnership where you could be somebody like Mid-Am and just acquire the project outright and get the PTC, but you can't do a lease. A lease does not work for PTC. If you want to do a lease structure on a wind farm, and that occasionally happens, but is relatively rare, then you could elect the ITC. So that's your alternative. Solar. I see a wide range of after-tax returns as the market is less mature. So the wind market is more mature, more predictable, kind of moves more consistently. Solar is a bit more all over the place. Solar City in 2015 said its tax equity returns are between 7 to 12 after-tax IRR unlevered. I see utility scale returns aligning closer to wind. Solar, you see a wide range. It depends on what size of solar project. It also depends on what's your relationship the tax equity investor has with the developer. Some tax equity investors say, all right, I'll provide you tax equity at an attractive rate, but I want your IPO, I want some investment banking work. Others say, we're not trying to do this to win investment banking, we're just trying to do this to make a profit, and we want as high a return as we can get. So that also impacts it, impacts the rates as to what other type of relationship you have with your tax equity investor. Solar City in 2015 said its tax equity returns were composed of 65% the ITC, 14% accelerated tax depreciation, and 22% cash flow. I found that to be an interesting statistic. ITC, unlike PTC, has these pesky recapture rules. So if you transfer during the first 5 years, so either if you transfer the project as a whole, or if you're doing a partnership and you transfer your partnership interest, you have to trigger recapture, and you have to repay a portion of the ITC. You can also trigger recapture in a partnership deal by having your allocations decline by more than a third. And we can get into that in some later slides about what allocations are. So you have to basically, the lesson is be very careful about recapture in solar ITC deals or any ITC deal, but you don't have to worry about it in a PTC deal. Because of recapture, secured debt is relatively rare because the tax equity investors say, we don't want a secured lender because if that debt's not paid, that lender could foreclose, and that foreclosure, if it happens in the first 5 years, would trigger recapture. So lenders are pushed to not to do senior secured debt, but instead to do what's called back leverage, whereby they don't have a mortgage over the actual project. What they have is a security interest in the developer's interest. So if the debt's not paid by the developer, the lender can step into the developer's shoes and take over the position of managing member, but the lender cannot, foreclose on the project itself and, have it sold at a auction or something. Can only kick out the developer and take over in that manner rather than a foreclosure on the physical project. And that's for tax equity recapture concern reasons. After that 5-year recapture period, kind of all bets are off, and typically a lender may have more remedies in the case of a default. There's a question. Yep.
Are you aware of any recapture events that really have impacted a debt provider?
Well, a tax equity investor wouldn't really. So the question is, am I aware of a recapture event that's happened in a transaction? And so recapture impacts tax equity investors if it occurs, and I'm not aware of one in this space occurring. Many years ago, not related to energy, in like widely syndicated limited partnership deals that were highly leveraged. There was a recapture event in like a 1980s tax shelter type transaction, but it was not had nothing to do with renewable energy. I think if you're careful and you have good lawyers and you're thoughtful, that you can pretty much avoid recapture. And it's just a matter of being cautious and documenting it properly. And recapture is not something I'm aware of happening that cause anybody a problem. Solar markets. Solar is divided into 3 markets. You see there's utility scale, which is generally thought of as projects over 1 megawatt. These projects are getting rarer because it's getting difficult to find attractive power purchase agreements for off-takers to buy the power from them, and without a power purchase agreement, most developers are reluctant to take the risk on developing a big utility scale project. Utility scale has also been dominated, not exclusively, but pretty strongly by companies like Mid-Am and Southern and others. But the utility the utility type public companies with deep pockets have been pretty active in the space. Then you have distributed generation, which is 500 kilowatts to 1 megawatt. That's typically municipal government buildings, big box stores. Tax equity investors are getting more and more comfortable in this space. You're starting to see portfolios of these deals being done and seeing more and more tax equity investors invest in those portfolios. Residential probably has the largest demand and the fewest investors, but that is expanding the number of tax equity investors. It can be a great opportunity. Many investors are a little bit skittish about it, particularly with the net metering regulation in Nevada. And you also have to deal with consumer protection laws, consumer finance protection laws, because your end customer is a consumer and they have protections and rights which would not apply if you're dealing with a corporate off-taker. So those are those three markets. All right. Now we're going to go into the partnership flip, and I'm going to lay out a bit of the legal structuring, and then Junteris will take over and talk about capital accounts and HLBV and other very important things. So here's a partnership flip structure. So you see the yellow triangle is our project company, which is a triangle meaning it's taxed as a partnership. And then it has two members. It has the investor member, the tax equity investor, which is the dark green rectangle, and that tax equity investor at the beginning is taking 99% of the tax attributes, and then after its flip is achieved, flipping down to 5%, and then the developer starts off taking 1%, and after the tax equity investor flips down, it flips up to 95%. You can't go over 99% of the tax equity investor, but the IRS rules cap it at that. And you can't go under the 5%, but the back end interest could be more than 5%. So sometimes you see deals where the tax equity investor flips from 99 to 10 or 99 to 15, or it flips from 99 to 20 and then after time flips to 5. All that can happen. So the 5 is a floor. You can do more. So typically the investor is putting in cash. The investor will make an upfront payment, and then they also make what we call pay-go payments, particularly in PTC transactions, because since the investor is getting the PTCs over time, it says, let me make my capital contribution over time. It also lets the investor kind of control its risk exposure better by putting in less money in the early stages and putting in more money as it's actually producing. And we've talked about the flip. We haven't talked about the cash sharing. The cash does not have to and probably will not follow those 99-1 type of percentages on the prior page. You can pretty much do whatever you want with the cash. So, but for complying with the capital account rules and having some level of pre-tax profit, you have a lot of flexibility with the cash. So the cash is being shared in different percentages than the tax attributes are, and that's a concept that at times people struggle with at first, but it's really critical to understand that we're sharing tax attributes and cash differently. Typically, the developer may have a purchase option. It cannot be exercised before 5 years. It's typically exercised after the flip point. In a PTC deal, you usually want to structure it so the flip occurs after the 10-year PTC period. In an ITC deal, you usually want to structure it so the flip occurs after the 5-year recapture period. And with that, when that flip occurs is usually when the purchase option arises. The IRS guidance for wind expressly says the purchase option can be fair market value, or it could be a fixed price that's a reasonable projection of fair market value. Oftentimes in the market we see the tax equity investors pushing for just fair market value and not the fixed price, but the tax rules do permit it. We don't have solar safe harbors like we do for wind. It's a bit of a question as to what the rule would be for wind, but it's hard to imagine the purchase option rules being different for wind than they are for solar. So the partnership flip has certain advantages. It's a pretty flexible structure, lets you monetize 99% of the tax benefits. There's a safe harbor. This revenue procedure 2007-65 provides a safe harbor. That's very nice. Lets you you have certainty that you're doing something that complies with the IRS rules, that you're not going to have a problem on audit. It's pretty widely used. It's been around since even before 2007, but even that 2007 safe harbor is 9 years old at this point. Developer's purchase option is less costly. By that I mean when the developer's exercising its purchase option, it's after the flip. So therefore, if the flip down is to 5%, developers is buying back 5% of the tax equity investors, 5% of the project. So the tax equity investors flip down from 99 to 5%. So rather than like exercising a lease purchase option, having to buy back the whole asset, developers is buying back 5%, which is not that big of a check to have to write, and it can be used for PTC and ITC. Disadvantages are that it's not 100% tax efficient. You have some tax inefficiencies because the developer has to take 1% of the tax items, 1% of the tax benefits. So that's kind of a lost, cost. Also, there's these complicated partnership tax accounting rules about short years, and so you have a little less depreciation in the first year. So those tax depreciation short year rules have some cost. Also, the investor has to be in the deal before the placed in service date, and that can be so the investor has to take some risk as to will it actually get placed in service, and that can be a concern for investors. And you have to deal with these complicated partnership capital accounting rules and financial accounting that Ginteras will take us through. So Ginteras, you take over.
Thank you, David. So on this slide, you can see a numerical example of a partnership flip structure. I'll probably repeat some of the things that David has just said. And as all of you know, partnership is a pass-through entity and doesn't pay income tax, which means that pre-tax cash and tax benefits are allocated to partners and taxed at an individual partner level. So the ultimate objective of the structure is to allocate tax benefits to a party that can use them most efficiently. So as David said, up to 99% of tax benefits are allocated to tax equity investor during the pre-flip period. This is the period when tax equity investor receives PTCs or ITCs and taxable losses due to accelerated tax depreciation. Now, on the cash side, pre-flip ratios can vary, and a developer is usually interested in receiving a significant portion of cash that can be back-levered, and it is not unusual for a developer to receive preferred cash distributions to recover development costs. On the other hand, tax equity investor, they want the developer to remain involved in the project and somewhat limit their upfront cash distributions, and tax equity investors sometimes also have cash-on-cash IRR targets. So the flip date can be driven by tax equity investor target IRR, or it can be date certain. And as you see in this table, that sharing ratios change after the flip date. So tax equity receives at least 5% of cash and tax benefits post-flip. So there are many variations of the basic structure, and different tax investors prefer different structures when it comes down to sharing ratios and other provisions. For example, deficit restoration obligation, DRO, so we'll talk about this later. Partnership flip structure, key considerations. So tax equity investment can reach up to 70% for wind project and up to 50% for solar. And tax equity market does not like project level debt, and back leverage is more common. From a developer's perspective, tax equity is probably not the cheapest source of capital. For example, of course, it's more expensive than that, but cheaper than sponsor equity. And the partnership has also to comply with complex partnership taxation rules. So each partner maintains a set of 704B capital accounts and outside basis. Generally, 704B capital accounts and outside basis cannot go negative. So they impact allocation of tax benefits and can lead to tax inefficiencies. For U.S. GAAP accounting purposes, partnership flip is a variable interest entity since sharing ratios are disproportionate and vary over life of the project. So this presents particular accounting challenges when it comes to allocation of pre-tax project income between partners. So it is very important to understand how 704B capital accounts and outside basis work, since they impact partner economics through potential reallocation of tax benefits, but also they can have impact on earnings under the HLBV method under US GAAP. So each partner maintains a set of 704B capital accounts and outside basis to measure what they put in and take out of partnership. And as mentioned before, both 704B capital accounts and outside basis restrict the amount of taxable losses that the partnership may allocate to a partner. Typically, ending balances cannot go below zero. Let's take a look at a numerical example. So here you can see 704B capital accounts for a partner. So as you notice, the capital account goes up by equity contributions and taxable income allocated to the partner, and goes down by cash distributions or taxable losses allocated to the partner during the partnership. So capital account starts at the sum of the cash and property at fair market value that partner contributes to the partnership. For ITC deals, the 704B capital account and outside basis are also reduced by 50% of the ITC. So capital accounts can be quickly driven down by ITC basis adjustment, by taxable losses in early project years due to accelerated depreciation, and by cash distributions. So when the capital accounts go negative, there are several remedies available. One is the minimum gain, which permits a partner to claim losses, non-recourse deductions beyond its equity investment in the partnership. It also tracks the amount of these extra losses that will be charged back to a partner in the future, which is called minimum gain chargeback. Another way of dealing with negative balance in 704B capital accounts.
There's one thing on minimum gain, that requires debt. So it requires project level debt. So it's a relatively rare thing because project level debt is rare. If we had a market that was more comfortable with project debt, we'd see more minimum gain and have more opportunity to use that structuring technique.
So another way of dealing with the negative balance in a 704B capital account is the so-called deficit restoration obligation, DRO. So basically a partner agrees to a DRO, that agrees to the DRO will have to contribute cash to the partnership if it has a negative capital account when the partnership liquidates. So an investor typically caps DRO to a fixed dollar amount, and generally between 10 or 20% of its total investment. Also, some investors will not agree to any DRO. Now, a third remedy is so-called stop-loss reallocations. So in the event 704B capital account balance shows deficit in excess of any DRO and minimum gain, that loss would be reallocated to the other partner. So these are the three mechanisms that address deficit balances in 704B capital accounts. Now let's move on to the outside basis example. So similarly to 704B capital accounts, outside basis is increased by equity contributions and taxable income, and is reduced by dividend distributions and taxable losses. However, there are some important differences since outside basis starts with the sum and cash and basis of property, which is at cost, that the partner contributes to the partnership, and if the partnership has non-recourse debt, the partner's share of this debt is added to its outside basis. Another important difference is that outside basis can never go negative, and there are two mechanisms to address if the interim balance in outside basis goes negative. So one is the excess distribution. So whenever a partner receives a distribution that would exceed its tax basis, the partner's 704B capital accounts are increased. Another mechanism is suspended losses, which say that no allocation of losses can drag the partner's tax basis below zero. Unlike for 704B capital accounts, these excess losses are not reallocated to the other partner. They are merely suspended to be claimed in a later period when the partner's outside basis is positive.
So what's missing there that was present in 704B is the DRO. So the deficit restoration obligation will help you for 704B purposes, does not help you for outside basis purposes. So sometimes you see new investors saying, oh, I'm going to take all these losses, I'm going to provide a DRO. Well, that works if what's constraining you is your 704B. It doesn't work if what's constraining you is a lack of outside basis. DRO does not solve a lack of outside basis problem.
So these are the key concepts and definitions that we have just talked about. So DRO, minimum gain, and stop loss reallocation, they apply to 704B capital accounts, while excess distributions and suspended losses, they apply to outside basis. Now let's move on to a brief discussion about accounting. As I mentioned before, partnership flip structure is a variable interest entity where cash and tax benefit allocations are disproportionate. In this situation, conventional equity method is difficult to apply. Now, under U.S. GAAP, there is no specific standard that addresses accounting for flip partnerships. In the year 2000, American Institute of CPAs issued an exposure draft of SOP that introduced the HLBV method, or hypothetical liquidation at book value method. So what is the HLBV method? So in a nutshell, HLBV is an income allocation method that assumes a hypothetical liquidation of a project at book value and distribution of liquidation proceeds to partners per liquidation provisions in the partnership agreement. The change in the allocated liquidation proceeds to each partner during the period is recorded as book income or loss, adjusted for cash distributions or distributions. So let me repeat. So we have three steps. Step number one, we are assuming liquidation of a project at book value, and then we determine how much of the liquidation proceeds to allocate to each partner. We follow the provisions in the partnership agreement. As a final step, we calculate the change in the allocated liquidation proceeds to each partner and record the book income or loss adjusted for cash distributions and equity contributions. So we'll go later through a numerical example which will make this discussion a little bit clearer. So I'd like to talk a little bit more about step 2 in the previous slide, which was how the liquidation proceeds get allocated between the partners. Now, when we liquidate the project, the taxable gain is allocated in accordance with the partnership agreement. And a typical liquidation provisions, which we call liquidation waterfall, would be to first restore deficit balances in capital accounts of the partners. Step 2, for the tax equity investor to earn target IRR. Now, it's important to remember that the gain in liquidation is taxable. So we need to determine the amount of pre-tax liquidation proceeds and how these proceeds will be taxed to the tax equity investors so that they reach a target after-tax IRR. And in the last step, the remaining liquidation proceeds are shared according to the back-end sharing ratios.
So just one thing about that is that this is typical, and it's a good typical summary, but it's not written in stone that your partnership or LLC agreement has to operate this way. So, you know, another thing where you see investors occasionally make a mistake is to assume their partnership LLC agreement operates this way, and then you actually go to read it and you say, oh, but you have a step 2B, and you didn't take into account step 2B in your calculation. So it's just important that you always need to read the liquidation provision in the actual agreement and not just assume it operates as described, although this is pretty typical in the way most operate, but it's not the way everyone operates.
So let's take a look at a numerical example. So to start, we have several inputs into HLBV calculation. First is the project level pre-tax income. So this number would come from accounting system. Also, we need a net book value, assets less liabilities. This information also can be obtained from the accounting system. Then we need 704B ending capital accounts, which is a tax concept, and this can be tracked and modeled in a financial model. Then once we have these inputs, we calculate a gain in liquidation, which is simply a difference between the project net book value and the 704B capital accounts. Then you see this gain calculated here on the slide in blue color. So let's say in 2018 we had 9.5 million of net book value. The capital accounts were 5.2 million, so the difference is 4.3, which is the gain upon liquidation. And this gain gets allocated to each partner in a so-called HLBV waterfall. So these are the 3 steps that we described in previous slides. So step 1, to restore deficit balances in capital accounts, since deficit balances are positive, so these numbers are 0. Then in step 2, we allocate enough gain, this is a pre-tax gain, so that the tax equity investor reaches target after tax return. And step 3, the remaining gain is allocated according to back-end sharing ratios, which in this example is 95.5. Now, once we go through the liquidation waterfall, we can calculate the ending claim on equity. So we sum up the capital account balances and the allocation of gain in blue color, and we basically get the allocation of liquidation proceeds. So, for example, for 2018, liquidation proceeds, which is the net book value, was 9.5 million, and these liquidation proceeds were allocated 7.9 million to developer and 1.6 million to investor. So when this calculation is performed, then we only need to reconcile the claims upon liquidation, which is done at the lower section of the slide. So since this calculation is done within each period, so we do know the beginning claim on equity. We do also know the ending claim on equity. Equity contributions and cash distributions are also known from the accounting records. So the only unknown plug, which is basically partner level pre-tax income, that makes this reconciliation work. So let's step back now. So what have we done here? We took the net book value, which is a proxy for liquidation proceeds, and allocated this in a waterfall to partner, to developer and investor. And then we also allocated the project level pre-tax income, which, for example, was 91,000 in 2018, and it got allocated to developer 113,000 and 22,000 lost to tax equity investor. So we go through this calculation each period, and that's how the HLBV works. So this concludes, I think, our discussion about the partnership flip and HLBV accounting. So if you have any questions, we'll be happy to answer now.
No questions on HLBV. Okay. All right. Okay, we'll keep moving. Okay, so now we're going to mostly leave partnerships, although we'll come back to it a little bit in this lease discussion, and we're going to talk about lease structures. So we're going to talk about leases and how they can be used to structure ITC deals. Again, leases do not work in PTC deals. So first, we'll start with the very basic sale-leaseback, and this involves a renewable energy project, but it's really no different than a sale-leaseback of an office building or an airplane. So the project is sold by the developer, the blue box, to the tax equity investor, and then leased back by the developer. The developer then delivers power to the off-taker via power purchase agreement, and then the tax equity investor, as owner lessor, claims all the ITC, none of its 99% stuff, and tax depreciation. And as we've referred to before, the tax depreciation is reduced by 50% of the ITC. So that's the basis adjustment. So if it costs 100, the ITC is 30, and you take tax depreciation on 85. The developer as lessee retains physical possession and is the seller under the PPA. The structure has, again, like all structures, advantages and disadvantages. One nice thing is the structure can be implemented up to 3 months after the place in service date. So Congress gave us this, and this is decades old, this is not recent, but the statute as drafted by Congress gives us 3 months. So the investor does not have to be in before placed in service. The investor can actually wait 3 months, really know the project is going to be up and running and is all going to work, and then you do the sale-leaseback. So investors can really know that the project's fully functional, and even been working for a material period of time. In theory, you can get 100% financing. In theory, the tax equity investor, the lessor, is going to provide 100% of the cost of the project for the sale-leaseback. Oftentimes, you see it's actually less than 100% because the lessor says, well, I want a deposit, or I want a prepaid rent, or I want something. So, oftentimes it's not actually 100% financing, but in theory it could be. Developer retains some upside if the project performance exceeds expectations because the rent payments are generally fixed. So you have a fixed rent payment, and if you produce, more revenue than is needed to fund that fixed rent payment, you put that in your pocket. A very complicated Internal Revenue Code Section 467 enables the rent schedule to be what we call sculpted to optimize the returns. So the rents do not have to be the same in every year. And I'm not going to get too far into it, but in fact 467 lets us have one schedule which provides the amount that's paid and another schedule that provides the amount that is allocated or that accrues for tax purposes. So it's sort of like what I was saying about partnerships, whereby with partnerships you can have different percentages for the allocation and the cash sharing. For leases, you can have different amounts of rent that is paid in cash and that is allocated for tax purposes. The rules are complicated. They have to eventually kind of come together, but it does work. The financial accounting is more straightforward, although it's in transition at the moment, but it's still easier than HLBV. The disadvantage is that the purchase option is relatively expensive because the lessor, the tax equity investor, owns 100% of the project. He hasn't flipped. There's no flip for it to flip down to 5%. So you have to buy back 100% of the project, and that purchase option cannot be set in such a manner to be a bargain or economically compelled. It can be a pretty big number. So if you're the developer and you view it as, quote, your project that you want to retain for its full useful life, you have to consider, well, what's this purchase option going to cost? There's case law supporting a fixed price purchase option. Some tax equity investors these days are preferring then fair market value purchase options. If you're going to do a fixed price, it needs to be a reasonable projection of fair market value, and you're probably going to want to get an appraiser to set that for you and do an analysis supporting it. Again, it doesn't work for PTC. It's only ITC. There's a question.
So the new leasing rules coming out, is the sale-leaseback structure still going to be available to us?
You want to, Terrace is more of an accountant than I am, so want to answer that, the new leasing rules?
We'll keep it blank.
What? So yeah, the new leasing rules do not, ban sale-leasebacks. So the benefit of the lease in terms of the debits and credits for each period will be a little bit different, but they don't say you can't do sale-leasebacks. So I think you're still going to see them used, and they'll still be viable, but it will be a little bit different revenue profile than under the old FAS 13. Yep.
So on your fixed purchase cost,
yep.
They still like to keep some sort of buffer, but say you're about expecting for market value.
Right.
You want to see a buffer above that, 102.5%?
I mean, I certainly, as a tax lawyer, feel better if I see a buffer. You know, it's a nice thing to have, and you can. The IRS says, well, how do you know that that was, you know, right to the dollar? You can say, oh, well, I've got this cushion. Does the case law require a buffer? No, the case law doesn't require a buffer, but it's a nice thing to have and probably a prudent thing to do. Yeah, 102, 103. Yeah. Okay, good questions, thank you. So now we're on to the pass-through lease structure. And this comes up, in this structure, it's a little unusual because the tax equity investor is actually the lessee. Let's see. So let's talk about the diagram on the on this slide. So you see that the tax equity investor is the lessee, and the developer is the lessor, right? So the developer, there's no sale here. The developer leases the project to the lessee, and then the lessee again has the offtake agreement, but there's no sale. And so the developer leases the project to the lessee. Usually the lessee is going to make some sort of rent prepayment, which is sort of the tax equity benefit the developer is going to pocket, and then it's going to pay some periodic rents as well. What's very generous about these rules, and again, these rules are decades old. It's not something Congress did recently. I doubt if these rules were not in the code for decades that Congress would give us this today, but it's in the code and we have this today. What's very nice about these rules is even though there's no sale, the tax equity investor gets to claim an ITC based on 30% of fair market value, right? So just put numbers on it. Let's say it costs the developer $80 to build it, and then the developer leases it to the tax equity investor, right? You would think that the basis is 80 and the ITC should be 24, 30% of 80. But these rules say if the fair market value is 100, the tax equity investor can take a 30% ITC of 100 and $30 of ITC instead of 24. So you have to make a special election to have the lessor not take the ITC, to have the lessee take the ITC. The statute doesn't say you have to get an appraisal, but you probably want an appraisal because you're going to have to support how you came up with the fair market value. But it's an interesting structure. Sometimes it can be the right answer. It's particularly good for developers who are concerned about the tax bill they get from the gain on sale if they had to sell it in a sale-leaseback, but don't have enough tax appetite to monetize the ITC themselves. So if you have a developer that's sort of in this, you know, in-between position whereby it's worried about paying taxes from gain on sale, but doesn't have enough tax appetite to monetize the ITC itself, this could be a good answer for that developer. So the investor claims a 30% ITC based on the notional fair market value, as I said. The investor deducts rents as they accrue under this complicated Code Section 467. Investor has income inclusion equal to 3% of the fair market value for 5 years. So that 3 times 5 is 15, so that's at 15% again, but because there's no basis adjustment, because the investor is the one taking ITC and the investor is the lessee and doesn't have a basis, there's no basis to adjust, so instead we have this 3% of fair market value a year gets included as phantom income for 5 years, which equals to 15%. So it's sort of supposed to be rough justice to the 15% makers reduction you see in a regular deal. The investor has the taxable income from the PPA payments. The developer gets the depreciation. So you're not monetizing the depreciation. So hopefully, if you're using this, maybe your developer, again, doesn't have enough tax appetite to use the depreciation, but to use the ITC, but can use the depreciation, excuse me. So hopefully, your developer can use the depreciation so that that's not wasted. But sometimes you see the developer doesn't need it, and depreciation is kind of wasted. And again, the depreciation would not be on the 100 that the fair market value is. The depreciation would be on developer's tax basis, which in my example was 80. So the makers would be on 80. There'd be no basis adjustment. The ITC would be 30 based on a fair market value of 100, and then the income inclusion would be $3 a year for 5 years based on those numbers. And this would be a great structure, except you're not monetizing the ITC. And if you remember back to that slide when I was talking about the solar tax equity market, you know, I'm sorry, I just said you're not monetizing the ITC, goodness. You're not monetizing the makers. So this would be a great structure, except you're not monetizing the makers. And if you remember back to that slide where I quoted Solar City, the makers is a material part of a typical tax equity investor return. So you're kind of leaving that benefit on the table. So it's not perfect all the time, but sometimes it's the right answer, but it is a little bit unusual, and you have to make sure everybody really understands the tax attributes they're getting and the fact that the developer will be left with the makers. So then we kind of put leases and partnerships together, and we have this relatively complicated structure called the master tenant partnership, also referred to as an inverted lease. And here we're using the pass-through lease structure, plus we're using a flip partnership. So if you start at the bottom dotted triangle, that is a partnership between the developer and the tax equity investor. And it's the typical 99-1 arrangement, and it's going to be the lessee under a lease from another partnership. And it's gonna, as the lessee, it's gonna do a pass-through lease thing that we just talked about, and it's gonna take the ITC. So it's a flip partnership. It's the lessee, and it's taking the ITC. Then the lessor is another partnership, and the partners in the lessor are, again, the developer, but also the lessee. So what's very strange here, and you see it on the page with the two dotted triangles, is those are the same legal entity. So you have the lessor leasing to the lessee, and then you also have the lessee as a partner in the lessor. And that gets complicated. So if you want to go down this road, you got to brace yourself for some complexity. And it's a little bit of an unusual structure because of the lessee being a member or a partner in the lessor. It has, in fact, been the subject of an IRS revenue procedure creating a safe harbor, but the revenue procedure is for rehabilitation tax credits, also known as historic tax credits. So tax credits for the cost of refurbishing historic buildings. The IRS has not extended that to investment tax credits for solar. It would be difficult to kind of come up with a rationale as to why it works for historic tax credits, but not for energy investment tax credits. But they have not extended it, and it's a complicated structure. The safe harbor that's out there does not tell you how much of the lessor the master tenant partnership can own. So that line that coming out of the lessor triangle, the right side, it doesn't tell you how much of an interest it can have. In my conversations with the IRS, they said that they were told by the historic tax credit industry it was typically 10%, that it was just a 10% interest that the master tenant partnership had in the lessor. I've seen solar deals where it's 49% though. So the IRS didn't even give us guidance for that for the historic deals, but they've informally said they thought it was 10, but I've seen solar deals at 49. So those are issues you have to wrestle with. The revenue procedure for the historic deals also says, you know, everything has to be at fair market value without regard to the tax credits. And it's a little bit difficult as to how one would determine that, although I have seen some accounting firm reports recently that do a pretty good job of explaining that, but it requires a little bit of complicated analysis. So this is a bit of a mind bender, but can be a powerful structure in some circumstances. Then just at the end here, we have this chart that talks about the various structures and the pluses and minuses for each of them, are red, yellow, green. So green being a good thing, red being a not good thing, and yellow being somewhere in between. So for instance, for the flip partnership, it works for production tax credits. That's that first green circle, so that's good. The rest of them are all red because the other ones all involve leases, and leases don't work for production tax credits. The amount of a developer's upfront proceeds is yellow because it's not as good as the sale-leaseback, but it's better than the pass-through lease or the inverted lease. Cost for the developer to reacquire the interest at the end, that's yellow because it's better than the sale-leaseback. We have to buy back 100%. But it's not as good as the pass-through lease, whereby at the end of the lease term, the lease is just over, and it's like, you know, you return your car to Ford Motor Company leasing at the end of your lease of a Ford. You just give it back, right? So there's no purchase option to exercise because the car just comes back at the end of the lease in the pass-through lease. But in the partnership flip, you have to buy back your 5%. So it's kind of it's yellow. Taxable income recognized by the developer at closing, that depends on how you structures it, so it's yellow. Monetization of maker's depreciation is yellow. First of all, you're only monetizing 99%. Second of all, you have that short year problem I was talking about, whereby you get less depreciation in your first year. And then the availability of IRS structuring guidance, that's green because it's the one structure where the IRS has put out specific guidance for wind, and has given us, you know, specific guidance. We don't have to reason by analogy and that type of stuff, so that's green. Simplicity, as you see, nobody got a green for simplicity. It's yellow because it's not as bad as the inverted lease, but you know, it's still relatively complicated. Sale-leaseback doesn't work for production tax credits, but the developer's proceeds up front is the highest because, you know, the tax equity investor buys it for fair market value, so that's good. The cost to reacquire, it's red because you have to buy back the whole project. That's not so good. The taxable income recognized by the developer at closing is red because you're selling it for fair market value, so you have gain on sale equal to the difference between your cost to construct and your sale price. It does completely monetize the makers, no short first year, so that's green. There is some guidance. It's not specific to renewables, but there's some guidance. Simplicity is sort of yellow. It's definitely can be complicated, but you know, it's manageable. Pass-through lease doesn't work for production tax credits. The upfront proceeds is red because you're just getting the upfront rent payment. That's going to vary by deal, but it's usually smaller than what you would see in the other structures. Green is the cost to reacquire. That's what I was saying before about it's like leasing a car. At the end of the lease term, the tax equity investor just gives it back, so there's no purchase option. The monetization of makers is red because you're not monetizing the makers. That's going to stay with the developer. There's some guidance on it, so it's yellow. Simplicity, it's red. It's pretty complicated. The inverted lease doesn't work for production tax credits. Upfront proceeds is split between yellow and green because it's better than the pass-through lease. It's not as good as sale-leaseback. It's kind of in the middle there. Cost to reacquire at the end depends on the structure. That could be pretty small. It depends on how big of a stake the tax equity investor has in the master tenant and how big of a stake the master tenant has in the lessor. Taxable income recognized at closing depends on how you structure it. You're going to monetize some of the depreciation, so depending on how big a stake the master tenant has in the lessor, again, it could be that 10% the IRS was expecting, could be the 49% I've seen deals structured with. There's some structuring guidance, so that's yellow, but it's for historic tax credits, not for energy. Simplicity is red because it's very complicated. So that's kind of explaining that chart, and that may be a useful reference for you in the future if you're trying to think, well, what structure do I want to, you know, do I want to propose, so that you can kind of see what matters to you and pick, you know, what fits your needs best. So that's that. So that's that. Any questions about that chart or about leasing? Okay. Oh, question. So the question is, who's booking what between the investor and developer? Clarify, which party is booking what. I'll let Junteris address that.
Yeah, so let's say in 2018, you see that for the developer, which is on the left-hand side, they booked pre-tax income of $113,000, and the investor booked $22,000 loss. Now, it's a question, who consolidates the project. I think it's usually going to be the developer, right? So then you record the minority interest. This would be the investor's share of the pre-tax income on the income statement. So I think what can be confusing is that, you see that at the project level we have only $91,000 of pre-tax income. However, the developer is allocated more than 100% of that, which is $113,000. And the investor is allocated minus 22. But if you add the two numbers, this would add up to 91 at the project level.
So the question was to walk through how the actual equity is distributed on the balance sheet. So, Junteris?
I guess equity would be, the sum of your equity investment, minus dividends plus your allocation of the pre-tax income. There'll be a minority interest on the balance sheet. So the minority interest would contain, the equity investment by the tax equity investor plus the minus the dividends that they received and their share of the project pre-tax income.
And that changes with the valuation calculation every time?
Yes, you do the calculation every time, just to calculate the allocation percentages for the pre-tax income. You will know, the equity and dividend distributions from the accounting records. So those will probably accumulate on the balance sheet, as you move forward. The same will happen for the allocated pre-tax income as well. So you would, for example, add, this 22,000 loss in 2018 plus, you would add 66,000 in 2019. So that would be a retained earnings number. So this is going to accumulate with each period. These are just income statement numbers. These are not balance sheet numbers.
Any other questions? Well, if you do have more questions, you can either submit them online if you're on the webinar, or if you're in person, write them on the index cards, and we'll answer them on the blog, www.taxequitytimes.com. And we do welcome questions. But since we have no more questions, I want to thank everybody for coming and for their time and attention, and we really appreciate it. I want to thank Junteris for doing a great job on the HLBV and the capital counts and joining me in this. And for those in person, we now have a cocktail hour. Wish we could offer something to those of you on the webinar. Okay. All right. Thank you, everybody.